Okay, so we're back with the third and last part of our investing podcast episode with Jean Van de Walle. I'd like to ask you, what other valuation metrics besides current and historical CAPE do you consider useful for forecasting future expected returns across emerging markets equities? Would you also consider, for instance, price to cash flow for individual countries ETFs as a proxy for value and profitability, like Larry Swedrow suggests?
Well, I mean, you can use, there's so many different kind of valuation parameters that you can use, and they're all legitimate. So you have to have your own sort of mindset and, what you're comfortable with. And then you have to be sort of very, very aware of where things lie, within your framework. Right. So CAPE is good for like a historical kind of comparison basis. It makes it easy to compare a market based on its history. Things like P and price to cash flow, they can vary a lot depending on economic conditions and so forth. So, but they're fine too, as long as you sort of normalize them. I use a lot the cash flow, return on invested capital, EBIT ROIC. So operating earnings, cash flow. That to me has been always very useful. For industrial companies, not for banks. For banks, I look at price to book and return on assets. But I don't think it matters that much. I think people, when they're in the bottom up process, I think valuation is probably the least important aspect. There's so many other things that matter so much more, which is, valuation. When I say the present numbers and so forth, what really matters when you're evaluating companies is your subjective view of earnings growth and the management capacity and so forth. And unfortunately, none of that you can get through artificial intelligence or data mining. It's all just your own opinion, right? It's what makes a good investor. That makes the difference between a good investor and a bad investor is being able to do that with humility, understanding that it's very difficult to do. But so when you're looking at historical data, I like the CAPE. I think it works best. But if you can use anything, and you just have to adjust things like P. You have to adjust them for the cycle, for them to mean anything, right?
Right. While EM equities are currently less expensive than developed market counterparts, they also have been suffering in the last decade, is exhibiting lower earnings per share growth rates. Do you think that EM equities might benefit from a tailwind in the coming decade from better EPS growth and maybe currency mean reversion, given how expensive USD has become?
Yeah, no, absolutely. So that's the mean reversion trade that we're all waiting for, and that we've been waiting for several years, really. So it's just a question of time before emerging markets turn, and we get this mean reversion trade, not only for emerging markets but for all international assets. So it's not as if European equities have done better, or developed country equities have not done much better either than emerging market equities. So we're waiting for that mean reversion trade to begin. And as I said earlier, it's all about the dollar. It's all about dollar liquidity and risk aversion. And as we speak today, that it's just not happening. The dollar just gets stronger and stronger. And my view is that because of the instability and the risk that we currently have to the monetary system, I expect the dollar probably will get stronger before it gets weaker. So I'm being patient. I'm waiting for that mean reversion to start. If I had to guess, I would think within the next 18 months. But I'm waiting, and I'm not really going to become aggressive and allocate a lot of capital until I'm convinced that it's happening. And then once it starts happening, you get into a virtuous circle, and all of a sudden things can look really good. Earnings start getting better, multiples get better, the currencies get stronger. And that normally is a cycle that goes on for 5, 6, 7 years, and where you can make a lot of money. So I think it will happen, but your guess as when it will start is as good as mine.
In a segregated market where no companies from that country can raise capital from foreign investors, only local economic risk matters in determining an asset's expected return, and expected returns tend to be higher since investors are unable to diversify that risk. Would you consider investing in such a market, like, for instance, Iran's Tehran stock exchange?
Yeah, so I have friends who have, tried to invest in Iran. I have a friend who's been investing in Venezuela quite a bit. It's not easy because these markets, they're completely illiquid, and you basically have to buy stocks by making appointments with people. It's like there's no market. So for who has tolerance for that, and if you can't, it's difficult to allocate a lot of money. So, but if you have a small fund, say if you're managing $50 million or something, and then you can do that. But I wouldn't allocate like a huge part of a portfolio to that. But I think it makes sense. But you always have to have conviction on the story. There's no point in investing in a market just because it's cheap. But if you believe that that there's going to be an agreement with Iran, that the markets are going to open up, that all of a sudden Iran will once again be part of the investment community, there'll be like a normalization of relations. I think you could make good money doing that. The same with Venezuela. Venezuela, if something happens and the U.S., the Venezuelan government changes or becomes much better than the awful thing it is today, like historically, like none of these bad times last forever. So if you think that things are going to get better, and you're willing to take the time to make the investments and make the analysis in the investments, I think these are good opportunities. But they're very specialized trades. It's not something the average investor can do or really wants to do, right? I'm not doing that because I don't have it's not important to me. I don't think it'll make a difference. I would only invest like 1%, 2% of my portfolio. And so I don't think it would make a difference to my performance. So I'm not currently doing it.
Speaking about costs, how much would you pay in expense ratios to access an individual EM country, let's say?
Like in what do you mean by like management fees or
expense ratios for ETFs, let's say, total expense ratios
for like a country fund?
Yeah.
I mean, these things just get cheaper and cheaper. And that's one of the great things. I mean, in many ways, this is like the best time ever to invest. I mean, for somebody like me, for my business, I mean, it's incredible. These ETFs, the fees are incredibly low. The the trading commissions have disappeared. We don't pay for trading. It's like so, and they only get cheaper. So, I mean, there's any new fund that comes out is always cheaper than the previous one. I don't think that's going to change. So for all these companies that launch these ETFs, they just have to be creative in one way or another so they can charge more fees, right? So they try to do something to justify higher fees, but it's not easy. I mean, they'll always, if you look at the marketing materials, they'll tell you they have, the best artificially driven, quant model ever, which justifies 3% fees, but it's not easy to convince people of that.
Do you think that the higher expected returns for EM are worth the cost of negative co-skewness with the MSCI World portfolio, given that negative skewness may not be as easy to ride out and recover from as volatility, even if you have a long-term time horizon?
Yeah, I mean, I think we talked about that. It's just your view of expected return and correlations is all that matters. I mean, that for the asset class as a whole, right? For countries, I mean, as I said, you have to really be confident that you understand the politics and the drivers and so forth.
Speaking about costs, I have one more question. While EM stocks are less liquid and therefore have slightly higher spread and also turnover, the bigger issue is foreign withholding tax. EM stocks tend to have higher yields than DM stocks, and since dividends are not return on capital but return of capital, we actually pay more to receive them. Do you think that the higher costs of ownership are fully compensated by higher emerging markets risk premiums?
Yeah, so it depends on the countries, whether you have like a tax treaty with the U.S. and so forth. Every country is going to be different, and if you're a non-U.S. investor, it's different and so forth. You just have to look at all, and when you evaluate your returns, you have to look at all the costs. You have to make your decision based on an evaluation of all the different, the final net return, including all the costs. That's all that matters. If they're taxing 1/3 of your dividends, then you just have to put that into your equation. So obviously you're going to pay less for stocks in a country that's taxing your dividends like that.
Speaking about factor investing, what do you think about the specific factor risk premiums across emerging market equities? Are you, let's say, bullish on value or quality?
So I do a lot of factor investing. In fact, part of my allocation is based on factors, and I allocate to momentum, to low vol, and to value. Basically, are the three areas that I allocate to. Momentum and value they're a wonderful combination because they have wonderful negative correlation, so it's very attractive. And low vol, I think just in general, like owning quality companies with decent growth in emerging markets is probably the best strategy, right? So if you combine these different factors, that's very attractive. And then another thing I do, once again, in my sort of opportunistic view on the markets, particularly in non-taxable accounts, is I like to trade the cycles. So the business cycles. So typically every business cycle, as a cycle begins, you find that value is incredibly cheap. So you have most of your returns, practically all your returns in emerging markets value, happen in the first leg of the business cycle. And you get very, I mean, if you think about it historically, emerging markets value has outperformed emerging markets as a whole. So you've had a significant premium in value. And all of that return comes from the first third of the business cycle. And so it's sort of an easy trade buying deep value at the beginning of a business cycle. So when you can measure, the cycle having bottomed and the economy is starting to recover, you pile into deep value, and you get fantastic returns. And you can do this country by country. So, for example, any country, and you have some ETFs you can do this with, or you can do it with stocks. But I've been doing this pretty actively in India, in Brazil, and in different markets, playing that business cycle. Unfortunately, so these are short-term trades, so you have to do them in non-taxable accounts.
Many emerging markets equities are not ESG compliant. Do you think this might affect their returns? For instance, I believe in the St. Violi and Camerini study, it was found that countries with high corruption actually had higher expected returns. Although many people believe we shouldn't invest in corrupt countries.
Yeah, I mean, I don't pay a lot of attention to the ESG. What I have always done is paid a lot of attention to the G, so the corporate governance.
Uh-huh.
And the corporate governance is part of the quality. I think there is a quality premium to investing in emerging markets by avoiding, low quality companies that blow up, by sticking to quality companies that are, that don't suffer in every economic cycle. I think you get higher returns. So that's the governance. The corporate governance is a huge part of the quality. And you can build portfolios of high quality companies, and it makes sense. So that I think that's fine. The ESG thing, I don't really pay much attention to it. I have sort of a contrary view towards that. I've been a big investor in energy stocks over the past year. And that's mainly because of ESG, because ESG has taken out so much capital from that sector. It's actually made it more attractive, right? Because so many funds have sold their energy positions, so that it depressed energy stocks and it created a buying opportunity. So, but that's just opportunistic once again. That's not a long-term thing.
Overall, do you think investors need to be cautious applying an aggressive overweight to emerging markets in pursuit of high expected returns? Or right now it's a good time to be really aggressive like Jeremy Grantham, famous GMO value investor, recommends?
No, I am not aggressive right now. I am waiting. I'm in wait mode. I'm not doing anything. I'm waiting for everything to stabilize. I don't expect a good year for asset prices anywhere.
I know that we cannot do market timing, but when do you think it might become a good time to start, let's say, overweighting emerging markets? Do you have
when they're
any
really
year
cheap,
in mind? Or
they have to be really cheap. So read my reports on the Cape ratio, and I'll tell you when the time is right. They're not that cheap yet.
yeah, but investors, especially in my country, are also afraid of the other risk, of inflation risk. And they say, with inflation more than 10% right now in Romania, what do? You keep money in cash and you get, let's say, your returns evaporated basically in real terms, or you somehow try to get an inflation hedge. And people often discuss about um, stocks as being an inflation hedge, but they aren't. They only
No,
um,
I
offer
agree.
you, let's say, a risk premium, and that is on the long term and is not something guaranteed. Do you see any other inflation hedges in this environment, like, I don't know, real estate or any other assets?
Yeah, so I think you should have a mix of gold, which I think is a very good commodities, particularly like energy-linked commodities like copper, maybe lithium, some of these energy-linked commodities, and then real estate. Real estate should provide a decent hedge. So we're not talking about making a lot of money here, but we're just talking about protecting capital and being defensive. And that's how I'm positioned: is gold, silver, some uranium, some energy stocks. I think energy stocks are quite defensive here. And then real estate holdings, and then you need some cash just to have some firepower when you really want to start investing, right? So that cash is expensive,
Yeah.
but at least you'll have it. You'll have it when you want to start investing.
How much cash?
And I mean, that's a good question. Like on a short-term basis today, like in this environment, I think having up to 30% cash is a good idea.
Mhm.
That's because I expect the markets to not to stabilize until everything is a lot clearer. And I think there will be very good opportunities. But that can't be long term, because if you hold that for several years, it's just going to kill you, right?
Do you think that emerging markets assets are also good to have in your portfolio, let's say in the accumulation phase? Because I also think about these high returns assets as being higher volatile assets, and they might also affect your sequence of return risk when you are in the accumulation phase. So are they actually a good investment for the accumulation phase, or also good to have in the accumulation phase?
When you accumulation phase, you mean like when you're young and you're
Yeah,
accumulating capital?
yeah.
I wouldn't make any distinction. I mean, I think you should manage your portfolio, pretty much in a similar fashion. I mean, it's all wealth building, right? So it's part of owning a mix of different assets with high return profiles that are not correlated, or as little correlated as possible. And I think for a young investor, it makes perfect sense to own emerging markets within that context. So yeah, I mean, particularly if you're like investing really long term, like for retirement accounts, I don't see why you wouldn't own significant chunk of emerging markets today.
Do you think that rookies or beginners, let's say, should stick to a simple strategy of owning only a global index fund like FTSE World or MSCI or Country World Index, or they should do something more than that?
So I think you can get very decent returns with very, very simple strategies. Particularly in the U.S. market, where you're not like paying anything for these funds anymore. You can get a MSCI All World like for 5 basis points. So this is amazing. I mean, when I started investing, 30 years ago, you paid like 3% on these funds, and you paid huge commissions to get into them. So this is fantastic. I mean, you don't have any excuse not for build your wealth under these conditions. And so if you just own like U.S. market, MSCI All World, and then you own some bonds as well. I mean, and you you periodically reallocate, then that's fantastic. You're going to do very, very well over the next 30 years, 40 years, whatever. And you will outperform like 99% of portfolio managers, which is like, so that's the simplest thing to do. You can always add like another step. You may add like maybe some REITs to it or something. But that simple strategy already will give you excellent returns. And then you may want to add some REITs. You may want to add some emerging markets. And then you can always make it more complex. But you should only make it more complex if you have a high degree of confidence that you will actually add value by making it more complex. The thing is that most investors will not add value by making it more complex. And they'll never know because, it's very difficult to measure this kind of stuff. But if you could measure it, I think you would find out that actually most investors, they destroy value by adding complexity. So that's just the way it goes. And the evidence for that is just like so incredibly overwhelming. It's like, I mean, there's so many great reports on how like supposedly sophisticated investors, think they're adding value and they just don't. Right? And so that's a lot of people just invest because they find it entertaining, right? It's like, particularly when the markets are going up, it's very entertaining. When the markets aren't going up anymore, it's not that entertaining.
Yeah, as Rick Ferry says, simplicity is an alpha and complexity is a cost. And a lot of
No question. I didn't. That's exactly what I think.
A lot of investors, at least in my country, are doing some gambling. I mean, they are buying the dip because they think the price will recover, but there is no price-based mean reversion, only valuation-based mean reversion. And I think Peter Lynch once said, who is going to lose more? That investor who bought the stock at $100 price, or the one who bought it at $20 if the stock is going to zero. And that one who bought it cheaper is actually going to lose more.
I think, particularly when markets are going up, and most of the time markets are going up, people do like to speculate. They have that gambling thing. So what I recommend is like you allocate 3% of your portfolio to gambling, and the rest just put it on autopilot for the next 40 years. And you'll see that you can measure your performance of your gambling compared to the rest, and you'll see you're probably not doing well, particularly after taxes and costs. I mean, here in the US, we pay a lot of taxes, so it's not cheap to do all this trading.
We have discussed about a lot of, let's say, technical stuff, but generally people have this question, I have a lump sum of money, how do I invest it? So let's imagine you are a young man, a 30 years old young man, having a lump sum of 100,000 euros to invest today. How would you do it?
Well, just what we were talking about is very simple. You can go like to Vanguard, which is the biggest fund manager in the US, and they will give you like an all market fund, which includes basically the entire US stock market and bonds and some real estate. And they'll charge you like 3 basis points for this. I mean, that's a perfectly good way to invest. So that's the simplest thing. And then you can break that up. You can break that up on your own and do the different parts and then add complexity. And I mean, some people are really good investors. They're very smart and they spend a lot of time identifying opportunities. And then if you have that kind of expertise, you should use it. for high return opportunities. I mean, I think it's a small part of the investor community that has that capacity, but those who do, they should obviously do it. You should, if you have any kind of expertise in any kind of market, and you're quite confident in your expertise, then you should take advantage of it. So I feel I have that in emerging markets because I've been, doing it for 40 years, and I've evolved the markets, and and I hope I'm one step ahead of other people, but it's not easy to do that.
That's right. Jean
Anyway,
Van de Walle,
yeah.
it has been a pleasure to have you as a guest today into our investing podcast to discuss about investing in emerging markets. Eventually, how can our viewers learn more about you and emerging markets investing opportunities?
Well, Victor, thank you so much. You can follow me on LinkedIn, on Twitter, and I have my blog, as you mentioned, the Emerging Markets Investor, which sometimes I'm quite active on and other times not so active. And people should reach out if they want to exchange ideas or whatever. I'm always happy to discuss. And that's it. And thank you so much for the time. Really appreciate it.
Thank you very much. I would also like to applaud you for all your work you have done. Your blog is really amazing, and I'm a huge fan of yours and also of emerging markets. And I've learned a lot from it. And finally, I would like to ask you to, let's say, offer those who are beginners in investing some educational resources you might find useful for them to learn more about how to become better investors.
Yeah, I mean, there's so much out there. It's incredible the world we live in terms of the amount of podcasts like yours, and all the just. I mean, there's just amazing amounts of material out there, which is a new world. I mean, 30 years ago, you just didn't have access to anything like this. I do recommend Ray Dalio's, Bridgewater website. I think there's tons of material, and I think he's very good at explaining the world we live in right now, which is not a simple world. We're definitely in a complicated decade here. And I would tell anybody to spend a time reading some of that, and I think you'll get a good idea of the challenges that we face and how you can prosper in this world of ours.
That's great. Thank you very much, Jean Van de Walle. It has been a pleasure to have you today, and thank you for your time. I would like to also thank all the viewers who have watched our podcast today. Thank you very much. Take care and good luck in your investing career from now.
Bye-bye. Take care.